Welcome at today's session of continuing professional development, and I'm going to run you through the various property or real estate valuation methodologies. But first, before we get to that, I would just like you to look at the definition of market value as defined by the International Valuation Standards in 2017, because we always, and what I also want to try and bring to you today is how we as property valuers are looking at property versus estate agents. So we always have to keep in mind the definition of market value when we are valuing real estate. So there I've highlighted to you what I deem to be the most important terms there. It is the estimated amount for which an asset or liability should exchange on the valuation date between a willing buyer and a willing seller in an arm's length transaction after proper marketing and where the parties had each acted knowledgeably, prudently, and without compulsion. So keeping that definition in the back of your mind, we are going to look at the different methodologies and why we need to keep this definition in the back of our minds. You will see already with the estimated amount that's part of the definition is we as property valuers are just giving an estimate to our clients with regards to our opinion of market value, whereas market value will only be determined once a willing buyer and a willing seller sign that contract. Then we would know mostly that is where the market was prepared to sign. Okay, then these four valuation methods, there are the four of them. Obviously, as estate agents, you will usually use the comparable sales method. I'm also going to spend the bulk of today on the comparable sales method, again from a valuation perspective. But I want to spend some time looking at the other three methods. In the notes that accompany this presentation, I have given you a step-by-step description of the valuation methods for in case you're perhaps more looking towards commercial property and would like to know more about the income capitalization method. That method we apply for probably 95% of properties out there where it is an income producing property where you receive a rental for that property. Now, in that methodology, we will work towards a gross market rental. People, it needs to be a market rental. In other words, where will a landlord and a tenant sign a lease agreement today? And from that gross market rental, we will deduct the operating costs, which could include, obviously, rates and taxes, insurance, maintenance. Also called outgoings, and in that way we will arrive at a net market income. And to that, I'm now just giving you a very brief synopsis here, and to that we will apply what we call the capitalization rate, which is just a property-related term for a return on investment, a return that the investor in fixed property is required. And in that way you will derive the market value. Then, with regards to depreciated replacement cost, that we usually apply for properties which never comes onto the market or seldomly does. In this instance, we can think of government schools, prisons, sports stadiums, power stations, anything like that. So there's no ways that we can compare it to any sales that happened previously. There's no rental income derived from that. So there, the idea is that we are looking at that property and we are thinking, if there wasn't a government school in this town, what would have been the next step? The next step would have been to build the same school, exactly the same school, same finishes, and what is it going to cost us? But then we take a step back and we say, okay, so it's going to cost us 50 million to build a new school here. But obviously, we cannot pay 50 million for the school because it's an old school. Yeah, and you can see it in terms of its physical depreciation, and we have got three other factors with regards to that. So we want to depreciate, we want to reduce the value of that building to bring it in line with its age and functionality and whatever is happening in the immediate vicinity. So in that sense, we are depreciating the new replacement cost. And then we're still not finished, because usually the most challenging part of the depreciated replacement cost method is to find the value of the land as if it is vacant. Now, usually, imagine a school in a built-up area surrounded by smaller urban. You can see the challenge there. Now you have to value 2 or 3 hectares of vacant land. But usually that's the sort of more challenging part. And also, we as valuers or estate agents, we are not quantity surveyors that it is easy for us, to find replacement costs. So usually we will get some experts to give us some guidance on the building rates. Okay, so that is in short the depreciated replacement cost. And the last method, the fourth method that we're talking about, is the residual method. That method we will usually apply to either vacant land, not agricultural land, vacant land with development potential, or we will perhaps look at a dilapidated building in the CBD of Cape Town, Johannesburg or so, and we will look at it and see what is its highest and best use. Now, what are we prepared to pay for this land based on the use that we foresee for this land? So it will be a question of, say, for instance, developing 20 apartments on this site. That is what our zoning allows us, or our rezoning would allow us. And then we have to deduct for what is it going to cost us to build those 20 flats. Professional fees of your architects and quantity surveyors. And then obviously we also have to allow a developer's profit, because he is not doing this for free. And there we will have a discounted cash flow and so forth. It can be quite an intense valuation. You usually have to do a lot of research with regards to the residual method. Then lastly, just to bring it in, some people see the accounts or the profits method as a fifth valuation method. We see it as part and parcel of the income capitalization method. And the accounts or profit methods there, you purely use the financial statements of the entity. In this instance, say for instance a private school. So where you will use the depreciated replacement cost for a government school, for a private school which is run as a business, or a private hospital or hotels, there we will use the financial statements of the business, and from that deduce the net income per year, and then we apply a certain percentage of what we deem an operator will be prepared to pay for running the business and for renting the property to run his business from. So that is very short, the 4 valuation methods. As I said in the notes, there is a step-by-step methodology that you can follow in if you would care to or if you are interested, in perhaps valuing a property that you are getting involved in. Okay, then, as I said, the bulk of the afternoon we're going to spend on comparable sales, also more so that you as estate agents can see how property valuers approach the same subject. So comparable sales approach is again where we are trying to estimate the market value of a property based on recent sales in the same area. And this approach specifically entails examining the market to identify similar properties or comparable properties where that information is available. Okay, again, qualify those prices in terms of nature and the motivating forces. Compare all the different characteristics of your subject property with those properties that sold recently. Here we can specifically think in terms of time, location, physical characteristics, and sales conditions. And then also, obviously, you have to adjust that value based on the incomparable parts of that sales price. So With regards to the first step in approaching a comparable sales valuation is we make extensively use of the service providers like, say, Lightstone or Windeed. Lightstone specifically, I must say, I like that product. It gives you the legal description of your property. It will also, which is very handy, will give you the 20 most recent sales in the vicinity of the subject property, which is of course not necessarily comparable. They also have a product where you can get a transfer report of whatever properties were transferred, sold and transferred, and you can specify the dates, a certain period that you are interested in. I personally, especially if you are working in a market that has shown significant growth, I like to have sales not older than 6 months. But as I say, you can now define and see the more sales you have, the easier it is to pick out those comparable sales. And we also have tools these days like Google Earth. I mean, you can go into Google Earth, you can go and have a street view look at those properties, and before you even leave your office, you can sort of determine, you know, based on sales date, sales price, location, characteristics of that specific property, you can already try and identify where you think the most comparable properties to your subject property, and then you can perhaps just do a drive past. Again, where there's an advantage from the estate agent side is that we as property valuers never get a chance to see the inside of those houses. Nobody would allow you inside their house just because you need to want to determine, you know, if it's comparable to your subject property. So there's, from the municipality side, documentation that we can get in terms of size of houses or perhaps the number of bedrooms. But in that instance, with regards to that additional information, estate agents are in a very advantageous position where they have intimate knowledge of these houses that they are selling. In Cape Town, I'm going to just skip to that. We have what we call PropStats, and it's a company where they have all the different estate agents subscribing to their product, and they then give a list of the number of bedrooms, the age of the house, the quality of the house, the condition, and in that sense puts a product out there that other estate agents can use, and they can then use that for themselves. The PropStats, that's only located in Cape Town, but it might be a good idea if that can perhaps be replicated in other of the major centres. That is, from a valuation point of view, an excellent tool to have with regards to comparable sales method. Comparable sales is probably the root of all valuation methods. Because even if you're looking at a commercial property in terms of rentals, you need to compare different building conditions and quality to determine the exact rental. So it would be good to have a tool there where estate agents are like-minded with regards to descriptions of properties. I also in the notes have given you notes with regards to the difference between quality, which is usually about the workmanship, as well as the finishes in a building, versus condition, where we are looking more towards the age of the building versus maintenance, if maintenance is up to date. Okay, so the advantages of this comparable sales method is that we are basing our estimate of market value on actual sales that has happened. So I cannot stress enough that we as valuers need to do the research, and we have to talk to the local estate agents to get their opinions, to get their input on what is currently happening in that market, and what is perhaps the trends there, who would be your typical buyers. Would it be older people, perhaps families with school-going children? And that is the kind of information that you would want to find out from the local estate agents. Actual sales are also your most reliable indication of value. Here we are looking towards a property term called substitution, which says why would anybody in the market pay more for an exact same property? No, why would they pay you 10,000 or 100,000 rand more if the two properties are exactly the same? Okay, so it's easy to explain the logic and the principles of this method, and also this method is favored by our courts because there is certain evidence out there that the valuer have to research and base his estimate of value upon. So there's at least something to prove why you decided on a specific value. Then in terms of comparable factors, obviously people, we are looking at comparable sales here, so the differences must be limited to the minimum. You cannot go and value a double-story house versus a single-story house. Okay, or three-bedroom sectional title flat with a two-bedroom. There's different rates per square meter, sales rates, and so on. So try and limit those incomparable properties between the two properties to the minimum. Then again, if we can refer back to our definition of market value, which spoke about open market transaction, obviously the comparable sales that you are selecting to base your value on must be open market transactions. In that sense, it means arm's length. It means it cannot be between family members or people that have sort of given each other a discount here in terms of property sales. It must be between two individual parties. Then the conditions of sale must not be out of the ordinary. Again, here is where estate agents are very helpful. They might mention, you might tell them, do you perhaps have any background information on this and this sale? And they can perhaps tell you the reason why it sold for a little bit more is because the furniture was included in the sale. Something like that. So they can give you some background information to the sale. And then obviously also people's zoning must be similar or the same in the sense of obviously if you're valuing a property and it's got a residential, general residential zoning, then that would allow you to demolish that family home and put up a block of flats. So obviously one always needs to look at your zoning and your title deed when you do a valuation. Okay, then as I said, the adjustments obviously should be minimal because we are trying to get comparable properties and compare those with your subject property. So the adjustments that we as valuers would normally make is in terms of market changes. Cape Town is currently, or for a couple of years now, experiencing quite a property boom in the sense of 10% growth in the local market due to, I think, the perception of good local governance. So obviously, people, there's no ways that we can value a property as at today's date. And remember, market value plus data valuation is like name and surname. So we have to value, if our valuation date is today, we cannot just simply apply a year-old sale straightforward and say this is the value of the property today. We have to take into consideration that the market has changed and we need to do an adjustment for time. First National Bank is still doing a house price index. I want you to refer to their website for that index and find out how that works so that you can do that adjustment for market change. Then location is another important factor. Say, for instance, your subject property is located on a very busy road, but your comparables are all located in a quiet cul-de-sac. So that would also ask for some adjustment there, because obviously you would spend a little bit more to be in a quieter location. Then there's conditions or circumstances of sale. We have to look at that. Is it a cash sale? Is there a bond involved? Is there perhaps a property of the buyer involved? What effect that would have on the sales price? Physical characteristics is the one we usually spend most time on to make sure. Also 3 bedrooms, you have to make that adjustment. My sale is 4 bedrooms, but my subject property only has 3 bedrooms. So we will have to make an adjustment there and sort of estimate what the market will pay less for 1 bedroom less. And then we're back at time again. You have to make an adjustment for time if your sales are dated or if the market is quite active with lots of sales happening. Okay, we've spoke about physical characteristics, people. There we can have a look at earth size, topography, the size of the improvements, accommodation and facilities. Does it have a double garage? Does it have a swimming pool? Again, going back and making sure who is your most likely buyer and are they willing to pay for a swimming pool? Would they pay a certain amount, or would it be for them just a nice to have? So different markets will then determine that different demands. And again, we're back at quality and condition of the workmanships. So that is where you will make those adjustments. Now, if your subject property is very neat, but your comparables are perhaps, lack maintenance and so forth, that you will adjust. Then we also, people, look at transactions that we regard as outliers. In other words, I always think it is good practice to inform your reader that you have looked at that sale. That it doesn't appear as if you are cherry picking through the evidence. You are stating that sale there, and then you say, we have regarded it as an outlier due to this and this reason. So one of there's a couple of reasons there why the transaction can be disregarded by the valuers. And again, if you think back towards our definition of market value, there it says, buyers and sellers that act knowledgeably and prudently. No. So we can have, it can be too high or too low as a sales price. So it can be that your seller or your buyer is poorly informed of the market. No. Perhaps somebody coming in from overseas, they have to buy a house in a hurry for their families, and they buy the first house at whatever is being asked. Then what the banks call a forced sale, that is where the seller is over anxious to sell. In other words, at the moment it's around about 4 months on average that residential properties stay on the market, and the seller isn't giving himself the time to wait for the right buyer. So in other words, he will sign at a lower price, and the banks take that forced sale to be anything between 20 and 30% lower than what is deemed to be market value. So then we would also discard a sale that is obviously too low for whatever reason. Then sales within family, there's the arm's length transaction again that we need to comply with. Property has not been adequately exposed to the market. Again, you need time. You don't want your property to sell on the first day. Then it was perhaps priced too low. And then the last one can be that you are deliberately selling your property for lower than market, perhaps for tax evasion purposes or so, which is probably not an arm's length transaction for all we know. Okay, so there we would discard those sales, and we won't take it into consideration when we try to estimate market value. Okay, so the shortcomings of this comparable sales methodology is that, from a valuation point of view, is that we do not perhaps have inside knowledge on what exactly happened when that sale took place. Now, what was conditions, perhaps, discussions around that sale, and and which makes it difficult for us then to do the correct call. Another shortcoming is the subjective judgment of the value. And obviously what you might think is second rate, I might think is top quality. Those kinds of differences in opinion. And then lastly, which makes it very difficult, if there is a lack of recent and truly comparable sales. It happened to me once where I had to value an upmarket sectional title unit in Clifton, and there was literally no sales in that specific block of flats for the last 10 years. Now, everybody was very happy there. Then you have to obviously cast that net wider and try to find blocks of flats, sectional title that is similar to or comparable to your subject property. But I want you to introduce you today to the multiple regression. That is a tool, a statistical tool that can be used so to sort of take out the subjectivity of the valuer where they need to determine value. It can also, where there's no recent sales, it will also help the valuer by casting the net wider again and include older sales into this multiple regression model. So first of all, what we will do is we will obtain sales even if it's, say, 5 years old, and we will get sales out of what we deem to be a comparable neighborhood to that of the subject property, or perhaps sales in my subject suburb, but we can go back a number of years. There's PropStats again, as I say, really helps a lot. PropStats with their information that they obtain directly from estate agents after each and every sale, which makes it very easy for us to populate this multiple regression. Okay, so how the multiple regression then works is we are looking at certain typical value forming attributes or value determinants. And PropStats have this in their spreadsheet. So they will give us, PropStats don't give us, they give us the condition of the improvements, but they unfortunately don't give quality, which we feel would be first prize. But they give us earth size in square meters, they give us the dwelling size in square meters, the number of bathrooms, view, swimming pool, number of garages, number of parking bays. So each of these characteristics of the property is explicitly stated on the spreadsheet that you can buy from PropStats. And obviously, we don't know in this subject node that we are trying to determine a value of a specific property. So we will then hypothesize which of these attributes will be showing as significant in our equation. In other words, say for instance the number of garages or at least off-street parking in a suburb like the City Bowl, which is at the foot of Table Mountain, that would probably show up as quite significant, that people prefer to have off-street parking and they are prepared to pay for that. So this is a very nice tool to have because it can spot certain, the equation can lift out those attributes which a valuer would tend to ignore. And also you can have a look in your notes. There I've given you examples of the equation and what it looks like. So this equation will then show which of these attributes is statistically significant, and you can take out those attributes which makes no difference. To give you an example, we did a valuation of a property in an insolvent estate where we had to determine the value of that property in a neighborhood where there hasn't, I think there was about one recent sale and there was no recent sales information. So we then, based on Other evidence, we realized, okay, the value of the property should be less than 5 million, but we didn't know how much less. So in that sense, this multiple regression helped us quite a bit, where it then showed us that with regards to the earth extent, which was quite a significant driver, as well as the dwelling size was another one, and also swimming pool. Swimming pool was another. So then the equation, and you can have a look at that in your notes, the equation then showed us that the value of the property should be round about 4.2 million rand, which at least gives the valuer some evidence with regards to his ultimate estimate of market value. There, as I said, PropStats only includes the condition of the building in their material, and we as property valuers would very much like to see quality, that is the quality grade of the construction materials as well as the workmanship. So sometimes, even though you might have quality tiles on the floor, you can perhaps see that, this was a DIY job, which detracts from the quality of that building. Then condition, there is the observed, what you can see with the naked eye, the observed physical condition of this dwelling relative to all the other dwellings. And again, as I say, interior is usually a problem, but at least from the exterior, you can get an impression if maintenance at this building is up to date, and if money is spent on the upkeep of the property. Okay, so we've now spoken about all of the inputs with regards to the comparable sales method, but people, at the end of the day, the way that you transfer this knowledge to your client is of the utmost importance. Sometimes it happens that that report is the only communication between you and your client. And one must also not underestimate the general knowledge that your client has these days. There's lots of information available on the internet, through magazines and television programs and so forth. So this report, and I've given you the characteristics of a good report. At the end of the day, this report is a reflection of the work and the professional manner in which you've done your research. So first of all, there should be efficient communication between you and your client. Very important that you do not pad your report with unnecessary stuff. Give him the global economy or things like that, pages of that. Make your communication factual and direct to what is applicable to the circumstances of your client or your reader. Then the valuation report must be complete in the sense of give your reader the reason, what is the purpose of the valuation, what is the legal description of the subject property to make sure that we are actually valuing the correct property here. Give him information on the current zoning of the property, because that will be the legal indication of the legal use of the property. Okay, and also don't just state it in the report, also interpret that information for your reader. Okay, then obviously there should be the body of the report where your valuations or your research is done and your conclusions drawn. And then at the back of the report, give him a copy of the title deed. For us that's in the property industry, it's very, we sometimes think everybody has got access to the information that we have. But people out there don't perhaps know, where can I get a copy of a title deed? Or the zoning. No, you've already done the work. You might just as well include a copy of those documents for your reader or your client, so that he can look at that at his own leisure and make his own draw his own conclusions. Then the valuation report must be credible. People, very important how you do your research and how you interpret in an honest way, make an interpretation of whatever your research revealed. Even if it's not taking you where you thought when you started the project, where you thought the value might be. If the information is out there, give it over to your client, analyze it, make certain conclusions from that information, but put it in then. I mean, you are not just there for the good news as well. Give your client all the information that you have come across during your research of this specific property. Then also the valuation report must have a logical sequence. That's why give all your sales that you have come across. As I said, even if you're going to regard this sale as an outlier, put it in there, give the reasons why you are ignoring the evidence of that sale. Otherwise, afterwards, your client might hear that sale took place at this and this price and it was nowhere in your report. Okay, so, and then what we also like to do is we like to give the value of the property sort of just after the cover page. So then your reader can have this value, because that is what he's interested in at the end of the day. He has the value at the back of his mind, but while he is reading through your report, he can then follow how you came to your conclusions and how you've decided on that best estimate. Then the valuation report must also be well balanced. The reader does not want to read 3 or 4 pages a description of his property. He knows his property better than you do. So focus on that that will be of value to your reader. In other words, even sometimes we will include sales that is not comparable, especially if we're doing industrial or commercial properties. We will include sales that happened in the neighborhood because it is of interest to that property owner in that neighborhood. Okay, so we will include it, but we will say we didn't take it into consideration in our final estimate because we do not deem any of those sales to be comparable. So, and then also the last one is preempt any questions by a critical reader. In other words, if there's something that's bothering you, rather than shying away from it, address it in your report, because your client will come back and ask, but have you taken this into consideration, or what about that? So discuss that in your report and state why you're not taking it into consideration or how you've dealt with that issue in light of your estimate of the market value. Thank you. That brings me to the conclusion of the presentation. Please remember to answer the 10 multiple choice questions to obtain your 5 verifiable CPD points for the session.